Hello guys, Michael with you today, and I trade binary options on PocketOption platform. And in the description below this video, you'll find a link to my private Telegram channel where you can find a lot of useful information about trading signals and etc. Also, I recommend you to go there because you will have a link to register to PocketOption platform and get 50% fee on your deposit. So let's start with today deposit with a $10,000. As we can see, the price has grown sharply, but it went under the local level. I think it can still grow to its resistance level. So I'm making up trade for $200, and I propose today to talk about farming cryptocurrencies. Cryptocurrency is a unique investment asset. Its uniqueness and difference from all existing investment assets is present in many ways. In addition to its high technology security, cryptocurrency gives a lot of earning opportunities. For example, investors can buy cryptocurrencies in the expectation of their value increase, bought cheap, sold expensive. And even in the process of storing digital assets, you can get additional profit, passive income on top of the one received from the growth of its price. I bought it cheap, I will sell it expensive, but I am already receiving income. We're talking about farming, one of the most profitable types of passive earnings in cryptocurrency. Let's look at what cryptocurrency farming is, what risks are there, and how much you can earn from it. Decentralized cryptocurrency exchanges do not have their own source of financing that would enable people to continuously exchange cryptocurrencies, make transactions. In order for the market to always have sufficient liquidity and operations to be processed promptly, a special algorithm is wired in decentralized exchanges. The trade brought $384. I think we can trade on the other direction because the price has grown enough. I make a down trade for $200. So, cryptocurrency farming is a way to make a passive income through providing cryptocurrencies to the liquidity pool. For the cryptocurrency holder, farming looks like a deposit and a deposit in two types of cryptocurrency at the same time. The cryptocurrency holder gives not one but two cryptocurrency paired to the liquidity pool at once. For example, Ethereum and USDT are in equal ratio. A liquidity pool is a cloud-based coin storage that provides trading opportunities. Users who place their assets in the pool are called liquidity providers or farmers. After the farmer deposited cryptocurrencies into the liquidity pool, the funds are blocked on his account and become available to other users who are traders. Providing decentralized trading in the DeFi space defies decentralized financial instruments in the form of services created on the blockchain. Profitability of cryptocurrency farming. Farming is considered the profitable of all types of passive earnings on cryptocurrencies. To understand what levels of profitability we are talking about, I studied the yields in two of the most popular decentralized exchanges, Uniswap and PancakeSwap. The trade brought $384. Today is a day of reversals. I make a down trade for $200. Farming on the Uniswap exchange. Uniswap exchange operates in 6 networks. In order to send your cryptocurrency to farming, you should decide on the network, since both cryptocurrencies sent to farming must be stored on this network. Uniswap shows the daily yield from farming. For example, the farming for the USDC and Ethereum cryptocurrency pair at the time of recording this video brings 0.3% per day, or 108.5% per year. But not in all pairs the yield is so high. For example, the profitability of farming in stablecoins cryptocurrencies, the rate of which is pegged to the US dollar or euro, and currencies almost no risk of exchange rate difference. It's much lower. So the yield of 2-day USDC stablecoins equals 0.01% per day, or 3.65% per year. But it's important to understand that these returns are calculated based on historical data, so it is not a guaranteed return for those who only place their cryptos in the liquidity pool. Profitability may vary on it will happen on the demand for this pool of liquidity in the future. The trade closed at $384. and I think another reversal can be done, and I make a down trade for $200. Farming on the Pancake Swap exchange. You should remember that the costs of transaction fees reduce the income from farming, so you should study what fees a particular network has. For example, traditionally, transaction fees in the BNB Smart Chain, Polygon, and Arbitrum networks are significantly lower than in the Ethereum network. Therefore, farming with small amounts is unprofitable. Analyzing the liquidity pools, you can see that there are cryptocurrency pairs in which the profitability of farming is very high, but you should be careful. If at least one of the coins is unknown to the investor, you should first conduct a fundamental analysis of this coin and only there evaluate its potential. This must be done, first of all, in order not to be left with an unpromising coin after farming, the rate of which is rapidly decreasing. After all, the peculiarity of farming is that when an investor gives cryptocurrencies to the liquidity pool, he gives them in equal proportion at the current rate, but when he takes his coins from the pool, he receives them in other proportions, since the exchange rate has changed. To understand why this happens, let's look at the mechanism of farming in more details. The trade brought us $384, and now, as I see, the price hasn't fallen much, but it can still continue to fall, so I make a down trade for $200. Okay, so the greater the change in the price of coins from the movement when the farmer provided coins to the pool, the greater the non-permanent losses. In other words, when withdrawing their funds from the liquidity pool, farmers may receive less in dollar terms due to changes in the exchange rate of cryptocurrencies that they provided to the liquidity pool. When farming becomes unprofitable, farming can cause losses in the event of a sharp change in the value of one or both currencies. In this case, the farmer's commission may not cover non-permanent losses. Let's look at same examples of such cases. Option 1. The investor gives a cryptocurrency pair to farming, where one of the cryptocurrencies is a stablecoin and the second cryptocurrency has high volatility. Option 2. The investor gives a pair of highly volatile cryptocurrencies to the liquidity pool. The trade brought us $384. And yeah, I thank you guys for watching this video till the end. Don't forget to like, write any comment, share with your friend, subscribe, and go to the link to get a really nice bonus, 50% free on your deposit in the description below this video, and I share trading signals. Okay, so that's all for today, guys. Goodbye. Till the next video. Michael was with you.